Welcome to the network that powers the world's alternative investment marketplace. Welcome to iCapital Network.
At Yieldstreet, get complete access to unique investment products once reserved for the 1%. To build a modern portfolio that works for you now, we're here to help you make the most of your money so you can focus on fueling your future. Take your money and your life to the next level. Unlock your full potential with Yieldstreet.
Hi again. It's good to see what are now familiar faces. We have a great panel here, and I guess would like to start by asking you all why you think it's important to open up these, these maybe more illiquid assets to retail investors. Do you want to start us off?
Sure, happy to. Mm-hmm. So listen, I feel like in some ways I was at ground zero, right, at E-Trade, where we really sort of championed the idea of democratizing access through trading. And it wasn't historically available to what you thought of as the ordinary investor. And the idea was, how do you ultimately take a category and create it in a different way, right? Same thing's happening today. You just see life constantly reinventing itself. And in the days when we were first building E-Trade, you had a very standard 60-40 model and it worked. It worked for investors. Today it's just blown, right? It just doesn't work. And I think investors who are falling into what you would think of from a demographic segmentation perspective of accredited or high earners or whatever, are smart enough and thoughtful enough that they want access to products and solutions that they feel better meet their needs and the needs of their portfolio. And so firms like Yieldstreet and iCapital are blossoming as a result of it.
Yeah, I think from our perspective, I think we are really founded on the belief that access to and distribution of alts is fundamentally broken. So if you look at an institutional portfolio that has more than 50% allocation to alts, whereas the retail portfolio is less than 5%. So there is that big gap. And to Mitch's point, 60-40 is really has it's time for us to rethink that, given that it has been around for almost 6 decades. And our thesis really is that how do you modernize a consumer's portfolio by adding alts and private market investments that can generate some return for them, some income for them, just the same way institutional guys invest. And there was no easy way to access it. I think there are 2 real problems with private markets. The minimums are too high and the durations are too long. And so I think we're trying to figure out the right balance between how do you distribute those products, keeping those 2 variables in mind.
Nice to see you all. We started iCapital with a very simple mission, which was just to bring alts to a broader audience of advisors and their clients. We had all come out of the alternative investment industry, and really over the years of working in it, we're quite enamored with the return profile, the diversification, the ability to build a portfolio of alternatives that had an outcome that you desired as an investor. And we were really confounded by the fact that individuals and or high net worth client advisors were not taking advantage of the asset class. We were all on the institutional side. And so we set out to change that and to broaden the access to the asset class. We certainly didn't understand all of the structural and infrastructure related platforms that we were going to have to develop in order to achieve that mission. But we've invested very heavily in it. We've had a lot of support from some great partners who are both clients and investors. And it's enabled us to build a platform today that helps many of the world's largest general partners and the world's largest wealth managers connect in a straight-through processing manner using technology and easing that access. But when you think about it from just if you take a step back and look at where we are from a market cycle standpoint, and how there's still so little allocation to alternatives across high net worth or accredited investors, it makes you think people should be considering this asset class more carefully. The markets are probably fully valued, as many of the speakers today have been saying, and yet most individual investors have 60, 70, some have 100% of their assets in equities or equity-like products. And so we think now would be the time to educate your clients about the availability, and there are platforms out there today that make it a lot easier than it ever has been before.
Yeah. So the return profile, is exciting for retail investors. I'm curious about the risk, right? The risk for these investors. So maybe fewer investor protections, less information. Is this a concern, and how do you protect maybe less experienced investors in this space?
Sure, I'll start. So we think about it a lot from an educational standpoint. We've made a few acquisitions in the space around compliance, advisor training, requiring advisors to understand the asset class that they're selling to their underlying clients. And we have a lot more work to do in this area. The next stage for us is understanding people's portfolios and explaining to them the risk profile of alts within that portfolio. There really is no sort of Morningstar equivalent in the alt space. So a number of firms are doing great work. A number of general partners and clients of ours are doing really great work here around education. And so we're looking to play our part in that as well. And broadening out what we define as alternatives. So I think traditionally it used to be the very large leveraged buyout shops, in the 80s. And as you just see from the speakers here today, direct lending is a massive new area of innovation and growth. You now have segmented out private equity and private real estate and credit and hybrid vehicles across the hedge spectrum. And so what I think regulation needs to do is make sure that people are educated, and that if you are educated, it doesn't matter if you have $20 million or $2 million, or if you are educated and you understand what you're buying, the regulators should make those products available to people, and they're starting to, right? We're starting to see some of that around whether if you're a financial professional, not just if you have a large W-2 or a net worth, you're able to gain access. But there's a lot more to do here. Mm-hmm. We hope to play our role in that education and regulatory environment.
Mm-hmm.
Yeah. And I guess the commentary would be that I remember in 2000, effectively, when the internet bubble really blew. And again, I think we were sort of at ground zero for experiencing that segment of the customer base that was a hyperactive trader that probably didn't really understand the risks they were taking. They were massively over-levered. I think that was a really good learning experience. And from our vantage point today, investing in companies, I see a change in behavior, right? And one of the nice things and what drew us to Yieldstreet was, if you think about their customer base, in some ways it is self-selecting. Right? It's an accredited investor or somebody who's a high earner. They're going to take it upon themselves, I think, by and large, to learn, to educate themselves. And it's our job to make sure that we're doing that well. Mm-hmm. But I think the behavior that you saw in the late 90s and early 2000s, probably there's an aspect of that today in the gamification, mm-hmm. right? But otherwise, I think the vast preponderance of investors are more thoughtful about what they're doing. Unfortunately, what makes the news is the stuff that's more exciting when you sort of see the bad behavior, right? But by and large, when you look at it more broadly, I think there's just a difference in terms of a level of risk understanding and risk appreciation. And again, our job to educate consumers about what does it mean to have a risk-adjusted return.
Yeah.
You agree?
I think you guys covered it well. Fundamentally, we believe that data and technology has changed consumer behavior, and mobile has changed consumer behavior in the last decade. The content today, the way we interact with apps today is very different than 10, 15 years ago. Mm-hmm. So I think that level of transparency demands that you develop products that can educate the customer on the basis of transparency. And so I think at Yieldstreet, education is a critical component, but also the fact of the matter is that consumer is now engaging very differently. And in post-COVID world, what is going to be the role of advice? I think it's going to be very different than it was in pre-COVID world, right? And so how do you address that consumer and how do you engage with that is very, very important. The other aspect that Dan touched on is that regulatory aspect. Regulatory, we all know they are almost 10, 15 years behind. It made sense to wall off illiquid investments 20 years ago because there's no level of transparency. If you go to Yieldstreet platform today, you will get Transparency not in terms of just fees, but also in terms of what are the assets you're investing in, how are you investing in it, what's the performance. We publish a quarterly report of our entire loan book and our investment book online, and it's there for everybody to read. And so I think that has changed the dynamic. And to be honest with you, we could not have existed without Jobs Act. And Jobs Act really reduced or really opened up the definition of accredited investor, that really brought up almost 15 million people into the fold that would not be able to invest in private markets just 7-8 years ago.
Yeah.
So I think those changes are happening, and even including the expansion of the definition in terms of knowledge-based investing changed even 6 months ago. And you saw Department of Labor announce that 401ks will now be allowed to invest in alts and private illiquid markets. So those are the steps that people are taking. But listen, you take 2 steps forward, 1 step back. I just heard in the Ways and Means report that they want to actually prevent IRAs from investing into alts and things like that. So there is going to be always this back and forth. And I think the important thing is for us to work with the regulatory bodies and really kind of understand where and how alts will play a role, and just kind of keep moving forward.
Yeah. Are there other regulatory risks, or I guess I could also ask, what do you think the regulatory landscape should look like?
Yeah, I mean, I think we touched on a couple of things, but it's really making sure that there's a cooperation with the product manufacturers, the groups that are building these products. They're doing so in a very thoughtful way today, much more so than 10 or 15 years ago. And they're thinking about the needs of their clients. They're thinking about the education that you need to bring forth. They're thinking about adding some liquidity provisions to some of these products. That's always been one of the number one things you hear about. You hear about messy paperwork, offline processes, opacity around performance and fees, and you always hear about illiquidity. And so some of the largest GPs in the world have invested very heavily and innovated in this area to bring some liquidity to the marketplace while still generating really outsized returns for the level of risk that you're taking. So I think it should be a collaboration, and I'm not sure that we're really seeing that quite yet. As an example, Milind just mentioned these comments about the IRA. We've already seen some clients taking a very conservative approach, and there are even situations where clients have canceled investments based on the fact that investment may not be eligible in an IRA at this point in which time the legislation would pass. So I think it needs to be more collaborative and very thoughtful about the benefits of these alternatives. And we're not talking about people selling all their stocks or all their index funds or Vanguard funds and moving 100% into alts. We're talking about a modest approach based on the suitability, based on where that client is in their investing life cycle. And I think when things are done in a thoughtful manner with collaboration with the product manufacturers, the regulators, the platforms, I think we can get to the right place.
Yeah, I agree. Listen, over the years, I think we have been regulated by virtually every acronym. And I remember there were periods of time where at E-Trade, we had somebody from a regulatory body in one of our conference rooms around the world 52 weeks a year. And the experience that I had is that you have to treat the regulators in some ways as a partner, just like you do anybody else. And if you find you're willing to understand where they're coming from and what their objective is, and you also try to educate them on your business and why you're doing it the way you're doing, I've found that that's generally pretty helpful. And when you draw a pretty hard line in the sand, it never works.
Sure.
And when you try to ignore it, it never works. But it is by the very nature of being in financial services and being hyper-regulated, one of the things you always have to think about and navigate. There's just no way around it.
Sure. I mean, so we're talking about opening up alternative investments to a broader class of people, a broader group of people, I should say. I'd be really curious to hear where you think this leaves the hedge fund industry, where you think it might leave mutual funds. Yeah. Milind, do you want to start us off?
Yeah. I know the answer, so it's
listen, I think as far as so generally my view is that the next 10 years is going to be the golden age of fintech and financial services, mostly on the heels of DeFi and technologies like blockchain, fundamentally is going to change how people access and deliver financial services. So, personally, my view is that there is a lot of alpha that's going to come from private markets, and we are seeing that shift, right? Because a lot of the public markets has become passive from a retail from a retail investor standpoint. So I think that's really where we feel that alpha is going to come when it comes to kind of complementing your portfolio. And then the other thing really with regards to industries like mutual fund, one of the big trends you're seeing is fractionalization. And because you have access to data and technology and ability to fractionalize various things, the way we do actually even at Yieldstreet, or the way Robinhood does when it comes to stocks. So you might ask, why do we have to pay the payload for the mutual funds, right? Can you not create mutual funds on the fly, or potentially fractionalize mutual funds? And so there is an argument to be made that you could potentially not need mutual funds as much, and you could move everything into ETFs and things like that. So there is potentially a trend that's, in my view, going to move in that direction.
Yeah.
And it's already happening.
So I'll be more aggressive.
Okay.
Listen, I think there has been a long-standing, for decades, movement toward lower cost, right? You see it everywhere, and it happens in virtually every industry through commoditization. And the more that products become commoditized and franchisable, the more you're going to see price compression. And I'll give you an anecdote. So the last company I ran was private. After E-Trade, it was trying to disrupt insurance. And we owned a platform, we owned an insurance company where all we did was use the annuity chassis to provide tax deferral. In the early days when I got involved, we were doing a couple $100 million a year in sales. And by the time we sold it to Nationwide, we were probably doing $3 or $4 billion. Okay. Of that $3 or $4 billion, in the early days, 70% of the funds that got picked were mutual fund solutions that were wrapped in an annuity VIT, right, that were more expensive. By the time I left, 70 cents on every dollar was going into low-cost ETFs, right? The market is moving, and people are speaking about, ultimately, I think the model that is getting constructed for smarter, more thoughtful investors is passive low cost, and then add alpha through illiquids, right? And that, ultimately my suspicion is even the cost of access to illiquids will get democratized and continue to go down through platforms like Yieldstreet and iCapital. I mean, it's just the way of the world.
Yeah, I think Mitch makes a really important point around the adoption of ETFs and sort of that, the age-old debate between indexing and passive. And I think by some measures, index investing has almost become too successful, right? It has too much of a share of your wallet today, or most investors' wallet. And that's why I think we feel so passionately, so strongly about considering alternatives for your clients, because when you have such correlated markets and interdependent, international markets, and we have, a company that probably many people in this room never even heard of, yesterday, talk about some debt issues, and it brings the S&P futures down by 2.5%, and led to a very bumpy day. Even NASDAQ, which is likely not as highly correlated, is down 3.5% at one point in the day. And when you have that kind of interconnectedness and everybody moving up and down in that ETF or that index fund together, it really makes you think: am I diversified enough? Do I have allocation in other areas? Am I getting a share of the innovation and the value creation in the private markets? And again, we're not preaching 100%. I mean, obviously there's the Yale endowment model, and where they're north of 50%, and that may be appropriate for certain clients with higher net worths. But just understanding the role that a yield-oriented direct investment or private credit vehicle could play in your portfolio in the absence of publicly available options generating the same level of yield for the same risk profile. I think those are the types of things people should be considering, even at the lower end of the net worth scales. And we have products, as does Yieldstreet, to accommodate even far more sophisticated investors who really want to curate their own portfolio of alternative exposures. So this is fairly new, right? So I don't think anybody has been in the wrong. Obviously, the public markets have worked incredibly well. What's the trailing 15% or so annualized return over 10 years? But if you look at it, I mean, how many people think we're going to enjoy those same level of returns from 2020 forward for the next decade that we did for the last decade? I still vividly remember, being a bond trader in the late 90s, thinking things were a little bit wacky, but I was young, and I said, well, I'm sure all these people know better than me, and I don't know I don't know why I think the market's overvalued. And then obviously there's an 80+% drawdown in the Nasdaq over the next kind of 24 months, and a 10-year period of 0% returns, right, from 2000 to 2010. Not saying that's going to happen today, but if it were to happen today, I think people are better off with some portion of their money in alternatives, yield-oriented, real asset strategies, and taking advantage of some of the excellent managers out there. So,
yeah. I just wanted to pause for a second, encourage you to ask any questions you want via the iPads, but also if you're not able to do that, just raise your hand, and I can also call on you if you have a question. So we can do that now. We can also do that towards the end if you have any questions. Yeah.
What alternative assets, such as life settlement, litigation funds, what market segments are you thinking about or are coming up that could be approached and create a alternative asset investment?
I mean, I'll start. So at iCapital today, we have about $85 billion in client capital. So we have a very diversified portfolio of investments, and we have a curated menu of 20 to 30 funds on our flagship website at any time people can look at through their advisor. But we also have relationships where the CIO at an RIA or an IBD or the home office of a wirehouse is selecting all their own investments. So we work in collaboration with them. But we have about 800 funds, so that really includes the full gamut of alternatives. So, for specific asset classes, Milind might have a view on some of that.
Yeah, so I think at Yieldstreet you can do two things: buy direct investments as well as invest into funds. And on the direct investment sides, we cover like typically your 8 to 10 major asset classes, including real estate and commercial lending, small business lending. A lot of the stuff that was spoken in the previous panel from a direct lending perspective. And then we do some other esoteric stuff as, essentially art and lending against art or litigation finance. So you could do those in a direct investment. And then you can get access to a variety of different fund managers as well.
Yeah.
That gives you diversified assets.
Yeah, and also the 40 Act fund.
Yeah, and then, thank you, Mitch. We actually also have a very interesting 40 Act fund called the Yieldstreet Prism Fund, that essentially gives you access broadly across a variety of different asset classes in one investment. So if you don't want to take an active role and come to the platform whenever new investments are launching, you could go and invest into that 40 Act fund. Yeah. That has a quarterly distribution of 8%.
Yep.
What role do you see for the bulge brackets playing into the alt space, private credit, given that the disintermediation has taken a big chunk of revenue away from them? They can't ignore it. How do you see them playing a role?
So a lot of them are doubling down on their wealth management areas, as you know, and so I think, and they're sourcing their own and diligencing their own private credit managers. So I think they're playing it through different channels. I guess if your question is more about if their syndicate desks are not as active because of the rise of the private credit funds and the size that some of those funds have become. I think it's an interesting question. I think some of the earlier panelists today made some very good points about the flexibility of the unitranche structures and why it's more appealing for entrepreneurs and business builders to work with the private markets for their direct lending. So I probably defer to them who spend their daytime in that area. But I think it's fascinating what we've seen, and I think there's long legs in that model.
But you also see a difference between wirehouse and wirehouse platform, right? Some are more open to an open architecture and allowing others in, and others just want a completely closed architecture. And my suspicion is closed architectures will be less viable over the long term.
I think if I may take slightly different tangent here, when you think about bulge bracket and like IB in particular, and capital formation in particular, I feel capital formation fundamentally is going to change when it comes to really what technology can help them do. So for example, on our platform, we have tens of thousands of people with like a savings account, right? And they have money deposited with us. And they tell us what type of investment preferences they have. So at scale, you could see platforms like us already aggregating demand for any investment opportunity, whether it's primary issuance or secondary. So our consumers, we could aggregate and say, hey, I have demand for $250 million for a 2-year product at 8% return. And so fundamentally, you could kind of flip the capital structure or capital formation, where now I could go to the funds and say, hey, don't raise capital, spend money on it. We will tell you the strategies that retail want to complement their portfolio. And so there is one way to think about how capital formation might change in the future.
Yeah.
Anything else from? All right, so I would be curious to hear about what the role you think the secondary market plays in all of this. Yeah.
So maybe I can start. So I think secondary market and the concept of liquidity is so important for private markets and private market adoption, because historically, because the product is illiquid, you're not able to get a ton of consumers. Like, we still have a lot of faith in wanting to have access to that money. And if I were to take a poll here, I can assure you that all of us are sitting on way too much cash than we actually need, right? It's more than $10 trillion that's actually generating 0%, at the top 5, top 10 banks, literally giving us no interest, right? And so if you can really, and I think that's really where applications like blockchain can be really powerful, where if you could provide liquidity, not on a real-time basis, it will come real-time in maybe 4 or 5 years, but if you could provide liquidity, whether it's quarterly basis or some periodic basis, and really connect buyers and sellers to technology and make sure that you could really show the value of the asset and the asset class, and whether it is through technology or just through the platform, I think that's going to fundamentally change how people think about alternatives. So we have done some customer focus groups and surveys of our own customer base, and people have consistently told us that they will invest 40 to 70% of their portfolio size more if we would offer quarterly liquidity on all of our products, right? And so I think that's a really a very good, a lot of people are talking about it, but at scale it's not been done. But obviously now you're seeing Forge just went public last week, or announced to be going public last week, that provides
secondary
market for venture-backed companies, right? And they have processed $10+ billion of volume, and you now have 800 unicorns that have collectively close to $2.5 trillion in assets. And so how do you do that? And I think so,
Yeah, I mean, a quick thought on is I think people are really overly focused on liquidity for 100% of their portfolio. I think, to Milind's point, liquidity allows you to make mistakes, and we're all human, and behavioral finance is a real thing, and it's very powerful emotions, and it's statistically proven that people don't really, they're happy when their investments go up, but they don't think about it quite as much. They sort of assume that they're going to go up, but when they go down, they get irrational, they make mistakes. And there's some amazing data out of the mutual fund industry, because they can track their flows very carefully, that if you take sort of the 50-year average of sort of stock market performance, 8.5%, 9% per annum, the average fund in the mutual fund space would be something like 7% after fees and expenses, but the average investor in the average fund was something like 4%.
Yeah, exactly.
Right? Because they're constantly buying high or on the upswing, and they're constantly selling at the very worst times, right around the trough usually. And so it's so painful to hear that, right? Because people are investing, they should be investing for the long term. They should be giving their money, if you're going to be in an active strategy or you're going to be in alternatives, you should find the best managers you can. You should work with a platform that has diligence, or a major consulting firm has kind of blessed those funds. And then you should let those experts do their job, right? There's great alignment of interest in the alternative space too. I think much better alignment than you see in ETFs or mutual funds, right? Where they make the same amount of money, whether you make money or not, right? They get their 85 bips or 150 bips, whatever it is. You could be down 30%, they still made their 150 basis points. Whereas in the alt space, many managers, in fact, most managers, don't make any money unless you make money because they haven't hit their preferred return, and their carried interest or promoted interest only comes after you in the waterfall, you as the LP. So much better alignment, and you have very, very smart people in that space. You can't just go into any fund, you have to do your diligence, but we think there's some amazing opportunities there.
Yeah, and the thing I would add to that is, listen, technology changes everything, right? And so you have seen slowly this sort of democratization moving through equities, fixed income, where ultimately there becomes a secondary market, where there's more transparency, where there's a much tighter bid-ask spread. In illiquids, that has historically been less true. Mm-hmm. As illiquids move into mainstream, by definition, it will change. And it will change now because you have technologies that allow it, right? The whole DeFi movement around blockchain is amazing to me. Mm-hmm. Like I think it's the next evolution from when I was around watching the internet get adopted as a distribution medium, right? It ultimately puts you in a place where, we talk about this at Yieldstreet, you can use blockchain even within your own ecosystem to create a process that's a secondary market. And then ultimately, as it becomes more widely adopted, you can move outside. Mm-hmm. So I think you're going to see massive transformation in ultimately in infrastructure around moving markets and moving products within markets over the next couple of years.
Yeah.
And I think, Mitch, not to put you on the spot, but speaking about consumer behavior and data, trading platforms historically, right, Robinhood type platforms and E-Trade, the consumer that trades a lot is the more valuable consumer, right? Because you're always, this fear
transaction
with that. But they actually have lower performance compared to consumers that don't transact as much.
Yep.
Right? And so I think that just confirms, Dan, what you were saying, which is behavioral science in terms of how we think about our investment portfolio is very important, and to truly understand the liquidity needs and to be able to kind of modernize your portfolio, like that concepts, I think are going to be something that next few years are really going to evolve.
Yeah, but our job is to create the appearance and the reality of liquidity if somebody needs it and wants it, to make them feel more comfortable and educate them on why they should wait it out.
Yeah.
Yeah.
See, the challenge also of secondary market and liquidity is nobody wants liquidity till everybody wants liquidity.
Yeah.
Right. So
Yeah, you want to talk about it?
So, right. Yeah. So the question really is, are there options for secondary market to get out of illiquid private investments? So on Yieldstreet, we have one product that has that option. We offer quarterly liquidity. Outside of that, currently we don't have a solution to offer liquidity. So you have to stay through the term of or the duration of the investment. But we offer investments from like 6 months to 8 years. And so you're kind of building a rolling portfolio as a consumer. Obviously, at a technological level, Forge is an example that provides liquidity to secondary private company stock. NASDAQ Private Markets is doing some stuff in that area. But broadly speaking, if your positions are large enough, then you have traditional banking, investment banking helping you with getting liquidity.
Yeah, but in the medium term, before you ultimately adopt something like blockchain, which allows for sort of a ubiquitous movement, you can create your own internal ecosystem. Absolutely. Where you create a supply-demand imbalance. If somebody wants to sell, somebody wants to buy, it's within your ecosystem, you make it happen.
Yeah, that's on our roadmap actually at Yieldstreet.
Exactly.
Right.
Yeah.
Yeah. Right. Yeah.
Yeah, exactly.
Right. Yeah, I guess two points on that. One is a lot of the accredited investor products do have some form of liquidity on a quarterly basis, right. And so that makes them even more suitable, more appropriate for accredited investors. At iCapital, we formed a partnership with NASDAQ to allow for secondary liquidity within even our truly illiquid closed-end long duration vehicles. And as more entrants come into the marketplace and there's more dollars, more flow to those vehicles, and there are more constituents buying them, we'll have much tighter spreads, and it'll become a more fully functioning secondary market.
Yeah. So unfortunately, that's all the time that we have today, but it's been a very useful and enlightening conversation. So thank you very much.
Happy to.
Thanks.
Thank you.